All right, I joke we're going to have like a bull market in laser tag because we'll have all these abandoned buildings.
By all measures, we're talking a shit ton of money here.
We are. All we know about the history of finance is when you have what's called a duration mismatch like that, it breaks, and it breaks catastrophically.
What would you need to believe to be true in order for AI to not be a bubble?
That for the first time in history, people are making rational decisions in anticipation of cash flows that they can't possibly forecast.
Welcome back to Humans in the Loop. Today, we're going to be talking about the economics of AI, and I'm joined by Paul Kedrosky. Paul is an investor, writer, and research fellow at MIT's Institute for the Digital Economy. Paul, welcome to the show.
Hey, thanks for having me.
Let's start with a question that at this stage you might be bored of being asked, which is we're going to use the B word, bubble. Is AI a bubble?
Yeah, well, of course, but I mean that's not the saying that is saying something really obvious and kind of boring. Because if it wasn't, it would be the first capex build out in terms of infrastructure of its kind in 200 years that wasn't. But that doesn't tell you very much in terms of the implications, and it doesn't tell you very much in terms of whether or not AI is useful. But AI itself is unquestionably a bubble only because it's almost impossible for it not to be, given it's at the intersection of all the things that have made the biggest bubbles, certainly in U.S. history, and at the same time, the level of spending is now dwarfing any sort of prior comparable. So, but yeah, it's a bubble. But there's other more interesting questions, I suppose. Like, does that mean it's not useful? And the answer is, of course, not.
Yeah. I guess just to put the spending here into a bit of perspective, in 2026, Google's parent company Alphabet, Meta, Amazon, and Microsoft combined are expected to spend in the region of $700 billion, basically on building data centers and equipping them.
Yep.
That exceeds the annual GDP of a country like Sweden or Switzerland. I feel like people are, myself included, bad at picturing what big numbers really mean. So if we put this in like a time perspective, if you took 1 million seconds ago, you're talking 11 days ago. If you're talking 1 billion seconds ago, we would take us back to 1995. And if we're talking 700 billion seconds ago, that would take us back to the Ice Age, 20,000 BC. So in terms of just so we can wrap our heads around like the orders of magnitude.
The numbers are insane, and that's part of what got me initially, interested in what was going on, because I realized back almost 18 months ago that U.S. spending on data centers was roughly was starting to solve a puzzle, and the puzzle was, why is it that the U.S. is still growing, the GDP is growing relatively quickly, and yet it's not producing a lot of jobs? And when you got under the hood, I realized fairly quickly that depending on the quarter over the last 18 months, and somewhere between 30% and 70% of U.S. GDP growth on a quarterly basis in every quarter since then been data center spending. And so once you realize that it is so large, and it's not that U.S. GDP growth is like $2 and this is $1. We're talking in the trillions of dollars in terms of GDP. And then if you break it down from GDP to GDP growth, so when you see that, let's say, for example, the U.S. grew 2.5%, and half of that was data center spending, that's a remarkable statistic at this scale. So to put it in another context. And so that's been the case now for 18 months. It even kept the U.S. out of recession, which is bananas, in the first quarter of 2025. It's the largest sort of, if you want to think of it in another way, the largest private sector stimulus program in U.S. economic history. Granted, we haven't had a large private sector stimulus program before, but we just have one, meaning that it's not government doing the spending, it's the private sector. We've now exceeded the non-residential fixed investment associated almost all prior economic build-outs, including telecommunications and the fiber build-out. We've now exceeded rural electrification. We've now exceeded the interstate highway build-out. As a function of straight up spending, as well as a percentage of the economy, and as well as railroads, as well as canals. So you pick your episode in the last 200 years in terms of spending in terms of building out an infrastructure based on capital expenditure, we beat them all. The only one we haven't beat, and unfortunately I used this analogy recently when I was talking to some Germans, was rearmament for World War II. We actually spent considerably more at that time, and it did actually turn into a kind of private sector stimulus program. A lot of economists believe that it was probably one of the fundamental factors that took the U.S. out of the Great Depression was spending to rearm for World War II. But it's not a great anecdote to use in mixed German company. So
I bet that one went down went down well. I mean, we're talking.
That's context.
Yeah. So, I mean, by all measures, we're talking a shit ton of money here. Basically.
We are, to use the technical term, yes.
Exactly. And
there's crazier statistics. Just to give two more real quick, just because I think it helps to understand this. For example, data center, hyperscaler spending in terms of lending is now increasingly being driven by lending. They're borrowing the money. They're not just spending out of cash flows. And so one of the other things that I think is really important to keep in mind is the borrowing is now so large that if you think about the debt markets loosely can be characterized as sort of investment grade and non-investment. Junk, sometimes we call it. High yield is the more polite way. The hyperscaler borrowing now exceeds the borrowing of the 6 large banks in the U.S. So they are now the largest segment of the investment grade borrowing market in the United States, which is just, well, obviously unprecedented because, one of the things that historically made tech unusual wasn't just growth. It was that growth without debt. This was a relatively low debt business and a high cash flow. And so the notion that this episode has driven tech companies to become the largest investment grade borrowers in the U.S. bond market is really startling and should make people sit up and pay attention.
You said yourself, the question at this point of whether or not it's a bubble is not the most interesting dynamic here. And we'll kind of double click into some of these areas. I guess to start with, like, if we are talking about bubbles in general, I guess it's worth saying at this point, as we've just pointed out, pretty much the whole, not just US, but kind of global economy at this point is like a big bet on AI. So people get very, very, very angry sometimes when you start using words like bubble. What we're not necessarily commenting on in using the word bubble is saying, well, this technology is crap, right? It's sort of pointing to the underlying business model and like scale out that is going on here. But the
likelihood of and just to be clear, the likelihood of stranded assets afterwards, which is the term of the economic term of art for overbuilding, right? So the likelihood of overbuilding is very high. Consumers don't necessarily need to worry their pretty little heads about that, but from a financial standpoint, it has huge implications, and that's the aspect of the bubble that's interesting. But that has no bearing necessarily on whether AI is useful.
Yeah. So if we're talking bubbles in a general sense, you pointed to a few historical examples, but like what are the core characteristics of a bubble? What defines a bubble?
So generally speaking, it's whenever spending is in anticipation of future cash flows exceeds the present value of those anticipated future cash flows. So in other words, you're spending far more than can be justified, and then in turn, investors are loaning or investing in the asset in anticipation of future cash flows, but where the investment becomes detached from what those likely cash flows look like. So it becomes entirely sometimes what was called a greater fool idea, that we're investing on the basis that someone else is going to want to spend even more. And so you can think about it in those greater fool terms or the asset flipping terms. And you can see that, for example, in the new SpaceX IPO, where it's a bubbly stock in the sense that it's going to be coming to market trading at something like 100 times sales. There's no economic rationale for that. There's nothing in their business that suggests it warrants that kind of number, but it doesn't matter. So bubbles have this characteristic of both valuation and investment being claimed to be in anticipation of future cash flows, but entirely detached from any reasonable estimate of what future cash flows might look like. And then that begins to feed on itself, because once the asset starts moving and becomes detached from cash flows, there's no speed limit, right? There's nothing that stops it from spiraling further. And that's what we see in all these episodes. And eventually, of course, it all comes back down to earth. But this detaching process, both on the investment in terms of the inflow in cash, as well as on the individual investors or institutional investors on the other side. And that's what we've had happen here, that there's no economic rationale for the level of spending we're currently seeing. It's largely this idea that if I don't become an oligopolist and dominate the market as a frontier model vendor, someone else will. So I need to spend to make sure that I protect my position. But that is not because I think that the future cash flows will justify it. And so what's unique about bubbles, generally speaking, is they usually have one of four characteristics. That is, they're usually tied to real estate. So real estate is a great source of bubbles. Think about the global financial crisis. They often are tied to technology because it's a great story, and yet it's very difficult to figure out what the future cash flows will look like. So, the dot-com period, or, maybe possibly telecom. They're often tied to loose credit. It's really easy to get money. Nobody really cares. They're just like, yeah, take it. It's fine. It'll all work out. So loose credit is often associated with bubbles. And the last piece of the four is government policy. So if governments are really pushing, we saw this in the global financial crisis, with the idea was to make housing more affordable and pushing Fannie and Freddie out to do more lending. We're seeing this now because the US government in particular keeps characterizing what's going on as an existential battle with China. We must win this because it's about the future of the United States. And to a lesser extent, you see that in other countries. So each of those four forces can really drive the existence of bubbles because they have no relationship to cash flows. What's unique about this moment is that we're at the intersection of all four. So if you want to think about what makes this particular moment so unusual, is we have government policy, loose credit, technology, and real estate. And real estate's really important here, all conspiring and commingling to drive what's going on. Because from the standpoint of most investors, data centers are just apartment buildings. They don't have human tenants, they have GPUs. And so they just look at them as an instrument for yield, and they literally treat them the exact same way they would treat an apartment building. So that's the key issue here. It's not just what characterizes a bubble, but the forces that drive them, and why this one is at the intersection of four of the most powerful bubble forces you will ever see.
To paraphrase, I guess people are kind of writing checks now that future cash flows won't justify.
Yeah. Right.
And there is this rational break between, we're putting this money in now. We have no real reasonable way of justifying how we would make that money back in future. Those are some of the things that sort of drive the bubble factor. But I mean, I wasn't around, of course, at the dawn of the railroad build out in the US.
Yeah.
But I don't imagine that from a kind of hype perspective, right? When you're talking about railroads, it's a bit of a different consideration in terms of what you're telling people this thing is capable of versus you're dealing with.
Not really is the honest answer. The level of hype around railroads was in many ways more than almost any episode up to the dot-com period. This was truly, especially in the United States, where you had this giant country that lacked, predictable, stable communications and transport links east to west. So the emergence of railroads was seen as a transformative thing on par with the internet. It was astonishing. And at a point in the early 20s, railroads were analogous to currently the Mag 7 stocks, so the largest AI and tech stocks, Google, Meta, Microsoft, NVIDIA, and so on, are about 38% of the S&P 500 in terms of market cap. That is exactly the same percentage that the railroad stocks were of indices of NYSE, the New York Stock Exchange, in the 20s, pre the Great Depression. So, and that wasn't because the cash flows justified it. That was largely because the level of speculation and froth and excitement was right off the charts. And then most of those companies failed. And in part, the collapse of the railroad bubble was one of the factors that eventually led to the Great Depression. So no, this level of hyperbole, we've seen it before. And probably the best example was the railroads.
Interesting. What do you think the companies involved actually believe here, right? If there is just this break from reality going on, deep down, somebody has to believe. We're sat here sort of saying, oh well, there's no reasonable justification for the level of spending now. I guess somebody has to believe that there is reasonable justification of that spending in order for the spending to take place. So like, how does that, like,
But it's not in the
is it?
form of yeah, for sure. But it's not in the form of like a DCV or something, like a DCF. I mean, like a discounted cash flow. So it's not like someone's sitting there and saying, okay, we've spent 200 and whatever it is, 20 billion in the first quarter of 2026 in terms of AI data centers, and that's justified on the basis of my fancy schmancy Excel spreadsheet. It doesn't work that way. So what's really happening is, if you want to think about it in financial market terms, if you're familiar with the idea of a call option, which is obviously the option, the right to purchase a stock in future, but not the obligation. So you've got you create a kind of optionality on the basis of something that you could potentially buy in the future. So the way that the frontier model companies think about this, and I've spoken to lots of them about this on this topic, is essentially they look at it as a call option on two things. It's a call option on, let's say, the global TAM, and this is, I hate this argument, but nevertheless, let's say the global TAM for human labor is like $14 trillion. So what would you pay?
TAM, we're saying here, total addressable market.
Yeah. Like if we replaced all humans with AI and just swapped the money over, right? It's a ridiculous argument, but let's just take them at face value for the sake of argument. So the global TAM for human labor is like, 12 to $14 trillion. So what would you pay for a call option that would secure you that cash flow? If I was to tell you it's possible for you to take that TAM, humans, which is right up there with reducing us to paper clips, and what would you pay for a call option on potentially securing that cash flow? And the answer, of course, is you would pay, to use your terms, like a shit ton of money for this, because it's a call option on, a growing large cash flow. Let's say, you might put a 2 or 3x multiple on it. So to that way of thinking, which is a ridiculous way of thinking and fundamentally sociopathic, that is one justification that you will implicitly hear, that we think we're essentially, by building what we're building, and despite the cost, we're essentially trying to secure a call option on some large slice of the TAM for human labor. Okay, that's one. And then the more starry-eyed version is, well, there's all these huge problems out there, such as, it was climate change, human longevity, and everything else. What would you pay on a call option to solve those problems? And of course, it's a cheat, because the answer is you should be, if something gives you an infinite series, the answer is there is no maximum price, right? Because that's the definition of an infinite series. If I can have you live forever, you should be willing to pay anything for it. And so it's a tautology. It's a circular way of justifying very large cash flows. Nevertheless, people smuggle that conversation in under cover of night through the side door and say, well, yeah, but this is going to solve cancer, and this is going to solve climate change, and this is going to deal with human longevity. And again, you get into this argument that I should be willing to pay anything for that call option because I'm securing an infinite cash flow series, not least of which allowing you to live forever. So these are the two arguments in various, often very confused forms that people tend to make as justifications. It is not a DCF from a spreadsheet based on, spending whatever on an NVIDIA Blackwell.
So as I hear that, and tell me if I'm kind of reading this wrong, but like the call option becomes a kind of bet on a version of the future, and however unlikely that bet is to come to pass, it's like, well, yeah, if you had even a slim chance of
that's right
monetizing the whole of humanity, or like replace, what should you pay to be able to place that bet?
Right. And the answer, of course, is you should be willing to pay almost anything, which, given that, the expected value, to me, if you think of it in expected value terms, of a low probability on a gigantic cash flow is still a very large number. This is the problem, right? So even though you might think of it as a very low likelihood, it doesn't matter, because the size of the cash flow on the other side makes the expected value of your possible outcome high. And so the problem then is you get into this game theoretic issue where, if I don't do it, someone else will, which is another kind of abdication. I need to do this because there's all these other companies spending to get their own call options on this cash flow series: Microsoft, Meta, OpenAI, Anthropic, various Chinese companies. And so, I can't stand back and let this happen, because they'll often come to this kind of fake moral conclusion that I'm a better person than they are. So if someone's going to control this giant cash flow, it better be me than them. Right? Which is a very common justification. It's integral to Anthropic's argument here. We're the good guys.
we should be the ones trusted with this
That's right.
with this
Right.
responsibility for humanity. Yeah.
Yes.
Yeah.
Huge responsibility. You might as well put us in charge because we're the good guys.
Yeah. Yeah. So you talked about the different kind of like dynamics of a bubble, the kind of loose credit, the real estate component, the technological component. I guess if we were going to try and poke holes in the argument here for a minute, it was like, what would you need to believe to be true in order for AI to not be a bubble?
That for the first time in history, people are making rational decisions in anticipation of cash flows that they can't possibly forecast. It's possible, but it would be just so wildly unlikely. I don't even know why people want to play that game because it has no bearing. They can still play their game of AI is the most important technology in history, and AGI will generate an infinite cash flow series that will make me and everyone I know have Ferraris. You can still play that game. And so you don't need to say, well, not only that, but data centers themselves are a tremendous investment because. And so this is it's not necessary for you to make that argument. So it's baffling to me why people even bother, because almost definitely this is exactly what happens with canals, what happened with railroads, what happened with rural electrification, what happened with telecom, what happens cyclically with semiconductors. This overbuild cycle is integral to the, Carlotta Perez has written about this extensively in Technology Revolutions and Financial Capital. The only difference this time, which makes it potentially even more problematic, is in most prior episodes, people didn't go into it saying, you know what, we're going to overspend, but it always works out because it always has. Okay, that's true, but in prior episodes, people didn't justify the overspend by telling themselves that overspend was okay. This is a really big difference. We have this new notion of sort of an infinite get out of jail free card by telling ourselves it's always worked out in the past. Well, yeah, but the reason why it always works out in the past because we didn't know it always worked out in the past. Once you introduce this notion of reflexivity, that I can justify any spending because it always works out. And people literally trot out this explanation all the time. It's like, hey, wait a minute. Now you're playing a new game. The new game is it always worked out in the past, therefore it'll always work out in the future because it always worked out in the past. But no, that worked out in the past because people didn't know.
Okay. Yeah, it's kind of screwed logic going on there.
Yeah, but it's really common. You hear it constantly from all the usual suspects.
Yeah, okay. That kind of segues maybe a little bit into this part of the debate, which is like, okay, there are people out there saying, fine, like AI is a bubble, but bubbles on some level are necessary, quote unquote. The bubbles are a thing that needs to happen in order for society to sort of progress somehow. So I'm curious what you make of that. Well, whether or not you come across that sort of argument and what you make of it.
Listen, every 7 minutes, pretty much, I hear that argument, give or take. So that is just a variant of the other argument, the idea that it always works out. You're essentially still saying it always works out, and that's fine. You can make that argument. It's just recognize that it's a tautology and reflexive, meaning that we didn't always justify overspend by saying it always works out. As a matter of fact, it's relatively novel to do that. And so what it does is makes the likelihood of overspend even larger and the stranded assets likely to be even more material. So that's point one. Point two is that, yes, you have to get there. Or yes, in the long run, the assets can often turn out to be useful and probably will in this case. What's unusual about the assets in this particular moment is that they do have a relatively shorter, meaningful lifespan. And at the same time, they're being both securitized, used directly as instruments in syndicating debt. So GPUs increasingly are being unbundled from data centers and used to create cash flows, and in turn are being used for syndicated securities, much like in the old world of asset-backed securities and what have you. And so, but the problem is the productive economic lifespan of a GPU is very short. This is not like securitizing a railroad or securitizing an apartment building, securitizing a very perishable asset. So the ideas around this thing create a thing that is much more fragile than it might look superficially. The building looks very permanent, but everything inside of it is much more perishable and fragile, and yet it's being used to securitize and to backstop cash flows. The other problem, of course, is that when you get into this overbuild phenomenon, a good analogy to think about it is to think about it in terms of the U.S. shale boom of the 1990s. So there was this explosion in horizontal fracking that led to the U.S. now becoming, I guess, now the dominant petroleum producer in the world, and because of this technology, euphemistically called shale, but horizontal drilling. But one of the things that happened, of course, early on was that there was this explosion of supply because all of these companies had the same technology at the same time and produced vastly more supply than the market could withstand, and this caused a decline in price, and it also caused some other weird artifacts like the construction of natural gas pipelines that were left largely unused after the bust, and then in turn are now being, weirdly enough, repurposed sometimes to create natural gas flows for the behind-the-meter power generation for some of these new data centers. So in a perverse sort of way, you are kind of picking up the pieces from a prior bubble and building this bubble, which is sort of bizarre. So, for example, you'll often see some of the natural gas turbines being sited to power new data centers because increasingly they're using behind-the-meter power, are being situated near some of the semi-abandoned natural gas pipelines associated with the last bubble that went bust. So you can either say that's a great example of repurposing old assets, or, oh my God, we're just stacking bubbles on bubbles. It's your choice.
Yeah. So the next bubble is going to kind of make use of all of the empty.
Yeah. I joke that we're going to have a bull. Right. I joke we're going to have like a bull market in laser tag because we'll have all these abandoned buildings, So you're going to have a huge.
I'd be here for it.
Yeah. There's nothing wrong with laser tag. I actually like it. So So I mean, that's where we're going. And of course, to be somewhat more serious, the insidious aspect of all of this, it's really glib just to say that even if 50%, let's just pick a number of these assets become stranded, which wouldn't be implausible at all. It has other second-order consequences. For example, one of the reasons why regional economic development officials across the U.S. are often acting against the very loud protests of their constituents, like it's happened in Utah recently, it's happening in North Texas, happening in New Mexico, is because from their standpoint, they bid on, I don't know, the Ford construction facility for, truck XYZ. They bid on the Hyundai battery factory. And they got none of those things, right? Yet, their unemployment sitting at like 18 to 20%. They don't have great cash flows to support schools, healthcare, utilities, and so on. And along comes a data center developer who says, hey, I got a solution for you. I got this thing where I got like a 12-year lease from a bunch of prime credits, these hyperscaler guys who are never going to default. And I'm going to generate, I don't know, a few $100 million to $1 billion in tax revenues for you over the next 10 years. That's like, this is a very hard for for regional economic development officials to turn down. And so they end up often voting against what their own constituents say, because the constituents are like, I don't want a gigantic thing the size of Manhattan squatting in the fields north of town and making a large humming noise and soaking up water and raising utility prices. But they look at it as this generates tax cash flow. So we create these weird, even though you might say in the long run it'll all work out, in the interim, you piss off the voters in a really remarkable way, and then if it turns out this thing ends up being a stranded asset, well, now you're wrong twice, right? Because now the problem is the thing that was supposed to generate the cash flows is an abandoned facility on the edge of town, so you're in a worse situation than when you started. So the secondary stuff is really going to be painful.
Yeah, and I guess the reality is a data center doesn't actually employ many people, right? Once it's
built,
no,
it does not.
It's and
if you got a few hundred, that'd be up there.
Yeah, and I guess the demands on energy are generally going to kind of jack people's prices up. In terms
that's
of
the data, and the data is even more insidious because you also have a heat bubble effect. So these things are obviously huge heat dissipation problems, and that's why you have this liquid cooling issue. So the latest research shows a kind of a climate halo effect around data centers, roughly 2°C of warming within 5 kilometers. And this is, so you might say, well, that's just one data center. That's the problem. We have over 200 under construction in the United States, most of which are in Northern Virginia or North Texas. And so you create this kind of combined forcing function with respect to the thermodynamics and this kind of heat bubble phenomenon. So there's all these secondary consequences that really aren't well thought through, not least of which is okay, fine, even if it all does work out and the asset being stranded, all of the cash flow I was counting on goes away if the asset becomes stranded. That's cold comfort for me that, that I was just part of the great drama that is capitalism.
Okay, so I guess like what I'm hearing in all of this is, all of these core characteristics that have been common to bubbles throughout history are like alive and well in the heart
Yeah.
of the AI, the question of AI right now, and there are also these added dynamics. So you touched there on GPUs and things being more perishable. I guess what we're saying there, right, is that as far as I understand it, somewhere in the region of 50 to 60% of the cost of a data center is just buying the actual like microchips that this stuff runs on. And those are not something that lasts all that long, right? You have to keep replacing them depending on who you speak to every few years, give or take.
Yeah, more or less.
And
Yeah. I mean, again, a lot depends, and we can go as deep into this as you want, but a lot depends on how the GPU was used historically. And the analogy I often make is if I could buy a used car and two used cars both have 1,000 miles on them, but I know that one used car was only used to drive to church on Sundays by some little old lady, and the other used car was raced at Le Mans, but they both have 1,000 miles. Which car do I want? Well, that's kind of like GPUs in data centers. So if a GPU was used historically for training, it's kind of like the car that was raced at Le Mans. It was put under immense thermal stress 24/7. So the MTBF, the mean time between failure for those things, is much, much shorter. If it was used mostly for inference, different story. It's more like the car that was driven to church on Sundays.
Sure. So you've got these bubble characteristics. You've got these assets that are basically going to have a relatively short lifespan depending on their usage. And then, as you mentioned, there's this kind of circular logic going on where people sort of justify the spending because it's always worked out in history and therefore it must always work out in the future.
Yeah. It's cool. I guess it's hermetically sealed logic. It's the best.
Yeah. I guess for like the average person listening, I'm here in France, in Europe, and people listening maybe wherever they are in the world. But why should the average person care, right? Because some people might be sat there and thinking, well, yeah, most of these firms funneling the money into this, they're the richest firms in the history of mankind, right? If they take a hit, then like boo fucking who, But like what like paint the picture of like when a bubble bursts, how does the average man on the street feel it?
Yeah, so we just went through this with the GFC in 2007, 2008. So this idea that, and we heard this from central bankers even at the time, that this is contained, that this is just an issue with respect to institutional real estate investors. This is incredibly naive. Global financial systems are tightly interlocking. Debt is collateral for other assets and other loans. Everything, in a sense, is a multi-purpose asset that's used for more than one thing, especially once it's syndicated and moved through the financial system, like these increasingly collateralized loans that are being used to finance data centers. They end up everywhere. They end up inside of insurance firms. They end up inside of institutional investors. They end up inside of sovereign wealth funds. They are literally everywhere. For example, right now, just in the last quarter, the largest slice of data center investors now is no longer the U.S. investors. It's sovereign wealth funds in the Middle East and pension funds and insurance firms in Europe. So Europe's right at the center of this. Even if you're not building locally, your money is coming over to the United States and being used to finance these data centers via the debt that's being used. So the issue is that you can't draw this sharp line and say, oh, well, these are big, sophisticated investors, and if they lose money on this, nothing's going to happen. We just literally live through the consequences of not paying attention to a tightly interlocking system where debt is syndicated around the world. And what happens? And what happens is the financial system nearly seized up solid. And we had to go through this series of programs, TARP in the United States and others elsewhere, to make the system liquid again because everyone was functionally insolvent. And we nearly had a system with no banks. And so the same phenomenon is playing out now. It's just playing out in a different way because the orthodox banking system is over-reserved because of a consequence of what happened during the financial crisis. And so much of this is now leaking out through other channels. Like you might have seen, there was recently a series of episodes in private credit. So these are the sort of the new shadow bank financial institutions that do a lot of the lending and are able to do lending because they're not tightly regulated by financial regulators, and they're exploding in terms of their activity within data centers. And then also, as I said, insurance firms, oh God, help us, it's everywhere inside of insurance firms, it's inside of sovereign wealth funds and other places. So all that's happened is it's become harder to track. The size of the liability is everywhere and pervasive. It's just in different places. So the consequences, in many ways, could be much more dramatic in terms of seizing up the system if we get a series of cascading failures, which strikes me as inevitable. I mean, given that we're, heading towards some of the biggest overbuild in history. So that's why you should care. And I will say, by the way, and I actually have a piece coming out about this. One of the perversities, well, I had someone say to me the other day, they were in Spain, and they said, you know what? The Spanish are ballsy, man. They think that this AI stuff, who cares? It doesn't really matter and everything else. And whereas Americans are like worrywarts, used to be Americans were real risk takers. And it's now like polling data centers and AI in the US polls worse than ICE and immigration enforcement officials, which is pretty hard to do. And so polling worse than ICE tells you that you've got a serious PR problem on your hands. And so, of course, people think, oh, well, I just have to tell better stories. The issue isn't that. The issue is that people realize that AI is one of the first forces that's directed straight at white-collar workers, that this idea that it deflates the potential, the number of jobs, but also just the sort of wage deflation aimed at white-collar work. And we're seeing this already in some software engineering positions. And so that has a different consequence. And so if you live in the U.S., where healthcare is tied to employment, you have a very different reaction to someone telling you we're going to see, 18% layoffs across the board. Because it's not just that, how do I replace that income? It's I may, within 6 months, have a healthcare bill of $100,000 for some therapy that bankrupts me. So the issue that isn't so much that in other countries, I think some of the resilience with respect to how they think about AI is a function of a more capable safety net where they don't feel like this is as consequential. Whereas in the US, it could hardly be a more stark test of the deficiencies in the U.S. system, given that unemployment insurance is short and relatively low value in terms of replacement wages, and healthcare is tied explicitly to employment. So you lose employment, people might have here 3-4 weeks of savings. They're insolvent. They're bankrupt within a month. And so this is a shot right across the bow of people, and that's why people responding much more emotionally here than they are in other places, because they see it as a crisis in terms of their bargain with the state.
Yeah. Amongst those where sentiment is lowest is often amongst young people. Over the last few weeks, there's been this kind of wave of college commencement speeches.
Yes,
Eric Schmidt, former Google CEO.
That was a tremendous one, yes.
Amongst others, basically just getting booed because talking about AI in front of grads who are, resoundingly booing mentions of
it was
AI.
startlingly tone deaf, just this complete inability to read the room, and then to continue on, in Eric's case in particular, in this very bullying way, where he said, it really doesn't matter if you don't like it, it's coming for you anyway. And it's like, my dude, this is like Michael Crichton stuff you're coming on here. Like, are you sending like velociraptors after me? What's going on here? So, anyway,
I saw a funny clip from that show Hacks. I don't know if you've ever seen it. And she's a comedy writer in the show, and she describes it as the way tech guys talk about the inevitability of things like AI as technological rape. And
no, it's true. But you know what? It's a really good point, though, and not to completely digress, but I make this point all the time that technology people will tell you this, and that's one of the arguments they make in terms of this call option thing. Was they say there's this kind of inevitability with respect to you can't fight progress, you can't fight this, and I always call bullshit on that almost right away, because there's huge problems with that argument. Is we stop, quote, progress all the time. And that my line of patter on this is, if we're not stopping progress, I said, I have some tremendous technology for aerosolized Ebola and I'd like venture financing for it. And you can't get that. And well, why not? It would be much more efficient and a tremendous weapon. Why can't I do this? And of course, the answer is that in life sciences, we long ago realized that there are systemic consequences to what goes on. And we, rather than hoping we're in the timeline where everything in the multiverse, where everything works out, we realize we're in a timeline where it might not work out. And if we just let people go full Scooby-Doo and just screw around and create their own stuff in in basement labs, it might not work out so well for the rest of us. And so in life sciences, the presumption is you need to prove that this, not just the efficacy, but the safety of what you're doing. Technology, for various reasons, has been grandfathered out of that orthodoxy, which exists in energy, exists in life sciences, that you can't just blithely say, don't fight the future, it's going to happen. No, it's the opposite. We actually do say you can't do that. And so technologists have gotten out of that in part because so far they haven't killed that many people. And it's a good test now of whether or not, where it's going to go in terms of the likelihood of that continuing. But my point is we fight progress, not fight. We constrain progress all the time. And it's a form of the expression in the sociology literature of learned helplessness.
Yes.
It's a form of learned helplessness to say, like, I would like this to have this not happen, but iPhones, man, we can't do anything about any of this stuff, right?
There's a whole nother topic here, but there are firms now with much larger annual turnover than GDPs of entire countries, who and a much more globalized footprint of the economy, who then essentially I'm based in Europe. Europe, I think, has a very different view of this, depending who you speak to, of course. But in general, Europe is more regulated, for better and worse, and has a different view of this. But then a part of the inevitability story there is like, well, if you just regulate us in those countries, we will go elsewhere, right? And so in Europe, there are these huge debates going on about, well, do you kind of deviate from some of Europe's own beliefs in favor of sort of attracting the companies and the capital, or do you hold strong to it? And jury is very much still out on that one.
But this is the problem, and this has been the problem that companies have played with respect to tax regimes for decades now, right? Is playing countries off against one another. I mean, the analogy I use all the time is that, it's kind of like having a swimming pool and you have a sign at one end that says this is the peeing section and this is the other end you have said no peeing over here. It doesn't really matter with having those signs, because once you have a peeing section, it's all over, right? Everything permeates into everything. And so this is the problem, is that it's the same thing is true in global finance and in trade and in tax regimes, that fine, you can say, I'm going to do this and try to wall myself off. But the problem is if everyone else is defecting and saying, okay, well, you can come here, it's Ireland and it's tax policy or wherever else, you kind of become constrained by the lowest common denominator. And this is a really difficult problem to solve. And we've seen the consequences of it on both sides in recent months, because if you go the other route and you're fully integrated, well, then you have a problem of certain executives in large countries like this one who then weaponize trade against you, right? So we have tight trade linkages with all these places because we let down all the barriers. Now, all of a sudden, those trade linkages are being weaponized against us. So we're seeing the consequences of making all the borders, trade borders, porous and permeable. So I think there's a revenge effect going on now where it's going to go the other direction because people are rightly angry about having these trade linkages and, among other things, being weaponized against them. So, I think we're in a moment where it's not would be surprising to me if we did see more balkanization in terms of, AI rules and what have you, because we've seen the consequences of the reverse, which is the weaponization of trade.
Mm-hmm. Mm-hmm. Paul, we've talked obviously about the dynamics of what might make this a bubble. We talked about what are the global implications of if the bubble bursts. I mean, people have been yelling bubble for a while now. It's not that out there an opinion. It seems to me like you were one of the earlier, to your credit in, I guess, in saying so. Right. And at the moment, the show goes on, like the money is free flowing, valuations keep going, data centers keep being built. So what is it that precipitates the bursting of the bubble in your view?
So the answer, of course, is that if you actually knew, I wouldn't be talking to you. I'd be running a hedge fund.
Sure.
I'd have the trade on right now. And so I do spend a lot of time talking to hedge funds about this, though. And my general view on it is that because it's at the intersection of all four of these forces I've been talking about, that in statistical terms, the crash is overdetermined, meaning that unlike in prior episodes, there are many ways that it can fail from here. And the more ways there are, it can fail because it has to do with politics, loose credit, real estate, and who did I miss?
Technology.
Technology. Yeah, that's kind of important here. Because it makes the failure modes, multiplicative and overdetermined. So it's the only thing you can say for sure is that all of these interacting forces mean that the eventual implosion will come, faster and more precipitous than in other episodes because there's more ways to fail, right? So there's no single mode that you could point to and say when that's the thing that's going to happen first and it's going to fail because of it. I just don't see how you can say that. So my hunch is that token prices are falling like anywhere from 70 to 90% year over year, recent frontier model price increases aside. You've got this perverse phenomenon where we're stacking a long duration fixed obligation, 12-year notes in terms of financing data centers, on top of a short duration deflationary commodity, tokens. Token prices are collapsing and they're built on top of GPUs who only last like 18 to 36 months. All we know about the history of finance is when you have what's called a duration mismatch like that, it breaks, and it breaks catastrophically. And when it breaks catastrophically, all of a sudden, all of the debt gets repriced and most of it fails. My hunch is that's the way it goes, and that this fundamental deep structural tension between paying a fixed obligation with a deflationary commodity with a short duration is probably the most fragile part of this entire system. But, there's lots of other ways it could break.
Yeah. And what's the, we're not giving out trading or investment advice here, but like
right.
what's the kind of the market saying here, right? As a kind of indicative read of this sentiment, where the money is flowing and not flowing. We've been through a period of time where the companies connected to this that are public, like your Nvidias, for example, seen huge stock price increases. The Anthropics and OpenAIs, which may soon be going public. But yeah, what's your read of what is going on in the market right now, and what does that money flow tell us?
So the market got, I'll give it the quick version. So the market got somewhat negative about this stuff last year and then got burned by being negative. They were negative because they could see the overbuild coming and they saw the transition happening from training to inference, where more and more of the data center load was becoming inference, not training. And the marginal return on training was flatlining a bit. And then they got burned. They got burned because the skeptics and people who were the financial types and got burned because of the accidental emergence of this new class of products called harnesses, right? So harnesses are these things like Claude Code, Cowork, Codex, blah, blah, blah. And what those things did, I analogized them to being, really effective nannies who have to manage really bratty kids. So the models are really bratty kids who just want to break shit. And then the harnesses come along and kind of say like, don't break that, but do this and so on, and we'll manage them. But they also have a more fundamental thing, which is they produce a geometric increase in token usage. So people have them looping madly, doing quasi-agentic things like refactoring code or whatever the case may be. And so that produced this inflection point in terms of token consumption, which pushed out the likely sort of changes in the market in terms of the overbuild, because all of a sudden we went from, Open Router was doing like, I don't know, 1 trillion tokens per week earlier this year, and now is doing 25 trillion tokens per week, I think is the number, on that order of things. And that's entirely a function of the emergence of these harnesses. But you only get the emergence of these. I equate it to like the Saudis gave everybody a Humvee and said, look, gas demand's gone way up. And it's kind of like that, right? Harnesses are really great at using prodigious numbers of tokens. And it's not that they lack utility. They do have some utility. They just have a lot of utility in this one weird domain called coding, which is a profligate user of tokens in the first place. And so what that did was it pushed things out a little bit, I think. And, I think the current view is that the OpenAI, Anthropic, SpaceX, maybe Databricks, that these IPOs kind of mark at least a near-term top in all of this, probably later this year, because There's going to be so much retail interest. It's going to soak up in excess of $5 trillion. This is a bananas number. $5 trillion in public market valuation will flow into these, and they're going to immediately be added to the indices. So that probably is it's the single largest liquidity event in the modern history of capitalism, and that will have huge consequences in terms of future cash flows and then appetite for taking on more risk. So I think that's late this year is kind of that moment, but it got pushed out because of giving everybody a Humvee also had consequences.
Yeah. So I guess just to kind of put it in simple terms, right, is like in the age of just everyone's using ChatGPT, it's a fairly simple interaction, right? Most people are kind of chucking in some text, getting some text back. Tokens as the kind of currency in the background here are being, being generated, but the amount of data in that exchange is relatively small. And then once you scale it up, or once you broaden it to what you call harnesses, I guess we could call agents, you, particularly in the context of software, right, the amount of data sort of being passed back and forth just goes up like astronomically, right? You're suddenly asking, like, the complexity of the task at hand, the amount of data being passed back and forth just goes up by orders of magnitude. And therefore, from a kind of Anthropic or an OpenAI perspective, right, like, that's good for your bottom line. I mean, that's good. Like, that
it's actually bad for your bottom. It's actually bad for your bottom line. It's good. It's because you have to build way more capacity to manage this. It's actually uneconomic growth for them, but it's good for your top line. So that's exactly right. But that's the important distinction to understand. And just the way I frame what you just said usually is that historically, the way people use this stuff was fairly compressive. We would say, here's a memo I don't want to read. Tell me what's in it. Or here's an email I want to write an email. These are like 1-to-1 or sometimes even 1-to-0.5. Like it would generate fewer tokens based on more tokens, right? When I say summarize a document, that's a compressive application. It's taking the tokens in and reducing them and saying, here's what it says, don't bother reading it. Software is the reverse, where I take a modest number of tokens and produce prodigious numbers of tokens by repeatedly ingesting the code base, adding functionality, doing what are called smoke tests, all this kind of stuff. And that is, as you were saying, produces an explosion in terms of token use. But taking it back to orthodox work, most of work is not expansive. Most of work is compressive. It's people saying, at most, help me with a PowerPoint presentation, but more likely, help me write some emails, summarize some documents, these kinds of things. So the notion of extrapolating what happened because of the emergence of harnesses last year in coding to what will happen in all of white-collar work is, I think, a little bit misdirected and naive because coding is so unusual in that regard.
Yeah, I guess there are examples I can imagine, in creative work, right, where, like, I don't know, people are generating ultimately like feature films using generative AI, right? But to your
that's
point,
not most of white-collar work.
Yeah, right. So it's these are the exceptions rather than the rule.
Right. Yeah. Exactly. But that framing is really important to keep in mind in terms of people got in their head that something happened last year or early this year, and they couldn't really, quite articulate what. Well, that's what happened. Was these very effective nannies emerged, and the bratty kids behaved a little bit better, but it produced an explosion in token use in this one narrow domain called coding, and then everyone said, well, that's what's going to happen in the rest of the economy, and that's wrong.
Is there anything at this point? I suspect the answer to this question is no, but I'm really curious. Is there anything at this point that could emerge that would change your mind on what's going on here? Is there anything that could come along and suddenly, like, Paul Kedrosky gets out of bed the next day and thinks, you know what, actually I was wrong. This is not a bubble.
We're not building enough data centers. You're right. No. Well, I mean, yes, I suppose so. Like, okay, so here's the answer I give people, because I actually really like being wrong. My biggest fear in much of life. There's a tremendous book by a woman named Catherine Schultz called Being Wrong, where she talks about how the problem with being wrong is it feels like just like being right until you find out you're wrong. So I'm always going through life assuming I'm wrong about a host of things, and I hope someone tells me, because otherwise I just feels the same. I'm kind of in this amniotic fluid of thinking I'm right. So what would falsify the view is if, to go back to Michael Crichton in Jurassic Park, is that harnesses escaped containment, meaning that what we see happening inside of software is actually representative of what will happen across the board in the entirety of the economy, not just in white collar work, but in robotics and everything else. And so that is explicitly and formally representative will happen, because we will have this incredible explosion in token usage that would suggest that, and economic token usage, and that's important, not just token usage. Subsidized token usage isn't that important. So that would dramatically change the sort of the arc, the trajectory of what's going on. And I think, is it possible? Absolutely, it's possible. Is it likely? No, it's not particularly likely, but it's not impossible. It could happen. And I think you have to be on the watch out for that. And I have when I'm talking to some of the hedge funds I advise, it's one of the conversations we have all the time is, what are the signs of this stuff escaping containment? Is it, has it stopped just rattling at the fences of the compound in Jurassic Park, and is it actually out, killing random tourists yet? Is it escaped containment? And I think that's the sort of thing you have to watch for. Having said that, the more data center capacity you build, the more deflationary eventually token prices become, and the more markets they penetrate, it still becomes an even more dominant pressure in terms of deflating cognitive labor. So it still has these incredible secondary consequences that aren't adequately priced into anything we're describing or how the models think about things. Like, for example, the idea that you can just say blithely, I'll take 30%, please, of the $14 trillion TAM for global human labor. It doesn't work that way, because once you take it, it isn't $14 trillion market anymore, because it's going to get repriced radically if it's all automated. You don't continue, because AIs don't have unions. They don't need healthcare, right? So they're not going to be priced the same way. So what you actually do is cause a collapse in the value of labor and then take a slice of the collapsed value, right? And so the notion that this is somehow a stable system from which I can sort of take pieces, the more it penetrates more markets and escapes containment, the more fundamentally deflationary the force is, and the more those markets get radically repriced lower.
Paul, I usually like to finish on an optimistic note. I guess in this case, it's a little hard to see. It almost feels like there's a, you could argue, a lose-lose scenario here of like either it's a bubble,
Yeah,
either it's a bubble and the economy collapses, or it's not a bubble and we all lose our jobs. So maybe it feels a little bit like betting on your favorite sports team to get relegated. I'm not sure, but like, what's your? I mean,
that's what someone said to me the other day. It's kind of like saying, like, who do you cheer for in sports? They said, I cheer for anyone who's I cheer for anyone who's playing against Manchester United. Right? It's the same sort of thing, right? It's like a kind of negative pleasure, I guess. But no, it's a difficult moment for that reason, and I resist the temptation to just say, well, it'll all work out in the long run or something like this, because as Keynes said, in the long run we're all dead. So it's way more important to me to be realistic about what's happening, and to applaud people who are standing up and saying, even if for bad reasons, I don't want data centers constructed in my county, and here's why. Because even if just subliminally and subconsciously they understand that this is a stealth missile aimed at their livelihood, and in the U.S. where there's a high level of precarity already, that's important. These glib answers about you can't fight it and everything else, seeing people take action and feel like they have some agency, for me, is like one of the most uplifting things ever.
Yeah. Well, that seems like a good point to bring us to a close, Paul. So I really appreciate you taking the time.
Yeah, great. Glad I could do it.